it will take you 138 years for your money to double. You make a ton of money, but you don't have any financial education. So what do you do when you make a lot of money? You blow it. Now, when you blow all this money you have a bunch of nice things, but you have no money left. What's up, everybody? I am Jasprit Singh from theminority-mindset.com, where money minds rethink rich. Look, none of us are taught about money when we're growing up unless we were fortunate enough to be born with rich and wealthy parents. But for most of us, financial education is one of those things that's never taught at home. It's never taught in school, but it's so important for us to become successful, especially financially successful, because if you don't have that backbone for financial education, then you're not going to know what to do with your money. And if you don't know what to do with your money, it doesn't matter how much money you make, you're going to continue to be broke. That's why in this video, I want to go over some of the untold truths about money, and let's jump right into it. I grew up in a traditional Indian household. My parents are immigrants from a state in India called Punjab, and they're some of the hardest working people that I know. But since I was a kid, they always taught me the importance of working hard, being honest, and becoming successful. Now, I don't know how it is for you, but in any Indian house, the definition of success is very simple. It comes down to a very simple equation. Success equals being a doctor. If you become a doctor, you are by default successful. If you go out and you ask any Indian mom out there, the solution to becoming successful at anything is by becoming a doctor. If you want to make a lot of money, be a doctor. You want to be happy? Be a doctor. You want to be healthy? Be a doctor. You want to get married? Be a doctor. But now, if we dive a little bit deeper and we define what the success is as financial success, now things look a little bit different. Now, I know there's a lot of different definitions of success out there. Being happy, having a good family, being physically healthy, being mentally healthy, having a purpose. But for the purpose of this video, I'm going to be talking about financial success. So now, if the goal is to become financially successful or wealthy or rich or whatever you want to call it, if the goal is to become financially successful, is the solution to become a doctor? Well, becoming a doctor teaches you how to diagnose a sick person, how to take care of a sick person, how to do a lot of things. If I was sick, I would pay a doctor a lot of money to treat me. But being a doctor doesn't necessarily mean that you're going to be financially successful. Being a doctor means you are qualified to treat other people. At this point, every Indian mom watching this video is saying,
"Oh, Jasprit's just saying that because he's not smart enough to be a doctor."
And yeah, that might be the case. But if you want financial success, the solution is to be financially educated. Because if you're financially educated, then you have the resources and the knowledge to use your money to become financially successful. This is how the majority of people, probably something like 90% of the population, manage their money. First, you make money from your job. You get a paycheck. This could be $20,000 a year or $2 million a year. It doesn't matter how much money you make. You make money from your job, and the first thing you do is you put this money in your bank account, and then you start spending this money. So you got your home expenses, you got to pay for your car, you got to go buy some clothes, you go on a vacation, you spend some money, and then that's why I got this dotted line here. If there's any money left over, you save this money. Now, some of you might be better than others at saving. You might not spend too much money, that way you can save more money, but for the majority of people, this is how their finances look. You make money, then you spend a lot of it, and if there's anything left over, some of that money gets saved. If you're wondering, "Oh, Jasprit, how do you know how people manage their money?" Well, just look at the numbers. 1 in 5 Americans do not have $5,000 saved up for retirement, and 7 out of 10 Americans, the majority of Americans, don't have $1,000 in cash saved up to protect them from an emergency. But what the minority of people do is first, they get paid. So let's assume for this example that you're getting paid from a paycheck again. Now I'm gonna go right to left this time. This time they start by saving money. So you put some money aside for your savings first. And then you invest some money. So you put some money aside, then you put some money to work for you. And after you save and after you invest, that's when you spend. So it's a different order of events. The difference here is the majority of people make money, they spend their money, and then if there's any money left, that's when they save it and that's when they invest it. Wealthy people, the 1%, what they do is you make money and then you save it and you invest it first, and then you only spend what's left after saving and investing, because investing and saving is what's going to build your wealth. Investing is going to build your wealth even more. Saving is just really protecting your wealth, but you need to do these two things first. That way you can build your wealth. The simplest way to do this is to create a financial system. One of the things you can do is to follow our 75, 15, 10 plan. What that means is for every dollar you earn here, so you make $1 from your paycheck or your business or however you make your money, every time you make a dollar, it's gonna flow down in this way. Out of this dollar, 75 cents is the maximum you can spend, 15 cents is the minimum you should invest, and 10 cents is the minimum you should save. When you do this, now you're investing and saving your money and building your wealth first before you spend your money. Now, if you're younger and you don't have a ton of financial responsibilities, then this is your time to build. What you should be doing is following our 50-30-20 plan. That means now you're spending less money, you're only spending 50 cents out of every dollar you earn, but you're investing 30 cents and you're saving 20 cents because now this is your opportunity to build. If you don't have a ton of expenses, then invest and save more aggressively now. That way you can build the foundation for your financial wealth. This is where a lot of people put up a smokescreen. They say, oh, you shouldn't worry about money like that. Money doesn't matter. You should just work on being happy. And yeah, you need to be happy, but money is a tool, okay? If you are a good person, money will give you a tool to do more good. If you are a bad person, then money gives you a tool to do more bad. The size of your paycheck matters, but it's not going to determine whether you're going to become wealthy or not. It's what you do with the money you make. Because if you make $200,000 a year and now you're spending $200,000 or you're spending $220,000 with credit cards and loans, well, you're broke. But if you make $30,000 a year and you're saving 10% and you're saving 15%, you are setting yourself up for wealth. But now, in order to build that financial foundation, there's 5 other things that I need you to do. I'm going to be talking about these 5 things. First, you got to track your money. You got to know where every dollar you're earning is going. Then you need to build a financial shield to protect yourself. Then you gotta stop bleeding cash. Then you gotta put your money to work. That way your money can make you money. And then you gotta put fuel on the fire to amplify the system. That way you can build your wealth even faster. First, you gotta know where your money's going. Because if you don't know where your money's going, then it is going to disappear. So you need to track how much money you're making and where your money is going. How much money you're spending, where you're spending it, how much you're investing, and how much you're saving. You need to have a track of all of your money, and this is something that you need to do every month. Even if you're not a financial person, you don't like talking about money, this doesn't have to be too hard. There's a ton of free apps out there that you can use to help track your money and help monitor your money. I'm kind of old school. I just use an Excel sheet. I've kind of built my own pro forma and my own kind of system where in the beginning of every month, I write down on my Excel sheet how much money I made and where all my money went, because if you don't know where your money is going, it is going to disappear. In the business world, what we say is if you can't track it, you can't optimize it, because if you don't know how well a system's running, you can't improve that system. Well, it's the exact same with your money. If you don't know where all your money is going, you can't improve where your money is going. You can't improve your wealth because you have nowhere to see how your money is being spent. Once you start writing down where your money is going, the second thing you need to do is build a financial shield, because you need savings. Right now, the vast majority of Americans don't have $1,000 saved up, but the reality is sometimes life happens and emergencies happen and you need cash to cover that emergency, because if you don't have cash, then now you got to go into credit card debt, which is very expensive, or you got to get a payday loan, or you got to get a hard money loan. And in all of these situations, you are getting skinned alive by the lender. And I don't want you to do that, which is why you need to start saving some cash. That way you have a financial shield to protect you from emergencies. In general, your goal should be to save something like 3 to 6 months worth of expenses in your savings account. Now, this savings money is not money that you're going to use for a down payment on a house. It's not money that you're going to use to go buy a nice car. It's not money you're going to use to buy a new cell phone. This money is just sitting there to protect you from an emergency. That way you don't have to go into credit card debt when an emergency happens. So this should be your base goal, 3 to 6 months worth of savings. But if you really want to protect yourself and you want to be really risk adverse, then you should have something like 12 months worth of expenses saved. You don't really want to have too much more than that, because saving money is losing money. Your savings accounts are not paying that much in interest, yet at the same time, inflation is 2 or 3% a year. What that means is the price of things, the price of living is going up by 2 or 3% a year, while your savings are just sitting there flat. So if your savings aren't growing, but the price of everything else around you keeps going up by 2 or 3% a year, that means your savings are essentially losing value each and every day, which is why, yeah, you need savings to protect you. But you don't want to save all your cash, because your goal should be to build your wealth. And I'm going to talk about that in just a second. If you're subscribed to our YouTube channel, you know that I love using my credit card to make transactions, because anytime I use a credit card, I get cash back, I get points, and I never carry any interest because I pay off my entire credit card balance in full every single month. That way I get the perks and the rewards from the credit card company, and I don't pay them any additional money in interest. But a lot of people right now are getting skinned alive by the credit card companies because they're spending money on extra guac that they can't afford, And now you're having to pay 15, 16, 17, 18% interest on that extra guac, which is skinning you alive. And so what you need to do right now is stop bleeding cash. You know, it's always kind of funny to think about this because we talk a lot about investing on a YouTube channel. And I'll talk about, okay, if you get a 7% return on your money, this is what will happen. Or if you get a 10% return on your money, this is what will happen. And every single time I do that, people will leave comments saying things like, or where am I supposed to get a consistent 10% return? But at the same time, do you want to know somebody who is getting a consistent 19% return every single year? Your credit card company. And you are the one paying it if you have credit card debt. Let me show you what I mean. So I was reading on a NerdWallet article that many Americans are taking more than 10 years to pay off their credit card debt. So if your credit card company is charging you 19% a year, what would happen if you invested that money and got a 19% return on your money? If you could invest $1,000 a month, and let's say you can get a 19% return on your money every single year. Now, I know it's not very easy to get a 19% return every single year, but your credit card company is doing it. So if you invest $1,000 a month and you can get a 19% return on your money every single year, and you do this for 10 years, which is what a lot of people are taking to pay off their credit card debt, this $1,000 a month investment would grow to over $420,000 over those 10 years if you could get the same 19% return on your money. Well, your credit card is getting that 19% return on your money, and so your credit card is becoming wealthy because of you while you are staying broke. So what you need to do right now is you need to stop bleeding cash because you need to pay off your credit card debt as fast as possible. Credit cards are a tool. If you know how to use them and you know how to use your money, you can get a bunch of free perks, you can get a bunch of cash back for doing nothing except making your regular transactions with a credit card. If you don't know how to use a credit card, then you are being skinned alive by your credit card company, and you need to stop bleeding cash and you need to get rid of your credit card until you can figure out how to control your spending. And right now, you need to get out of credit card debt as fast as possible. That means cut your expenses, work harder at your job, get a raise, do whatever you gotta do, find some extra cash and put it towards your credit card debt because you gotta stop bleeding cash as fast as possible because this is eating away at your wealth. Once you get here to number 4, this is where things get really fun because now you're putting money to work. You can only work 10, 12, 14, maybe 16 hours a day consistently. I mean, yeah, maybe some days you can work 20, 22 hours a day, but you can't do that consistently, okay? You're gonna get burned out. But your money doesn't need sleep. Your money doesn't need to go to the bathroom. Your money doesn't need a vacation. Your money can work for you 24 hours a day, 7 days a week, including holidays, which is why once you got this extra cash, you need to put it to work. That way your money can earn you more money because you need your money working for you while you're sleeping. This is what investing is all about. You're sending your money out, that way your money can attract you more money. Lots of people assume that putting your money to work and investing means that you have to throw your money in the stock market, but that's not the only way that you can invest your money, and it depends on what your risk tolerance is. One of the simplest and easiest and the least risky ways to invest your money is just by paying down your debt. If you have student loans that are costing you 6% a year in interest, and you pay it off a year early, well now you just got a 6% guaranteed return on your money for that year, because now you don't have to pay 6% in interest to the bank or your lender. That 6% is what you get to keep in your pocket because you paid off your student loans a year earlier. This doesn't have really any risk because if you pay down your debt early, that's interest that you don't have to pay. You should also be investing in yourself and your own mind because like everybody says, you are your own best investment. If you know how to use your money better, you can use your money better and get a better return on your money. Now, this takes time and it takes money, but this can be one of the most valuable things that you do because if you don't know how to invest your money, then you're not going to be able to get the best returns. So this could mean reading books, it could mean taking classes online, it could mean going to seminars, whatever it is. You need to be investing in your education, especially your financial education, if you want to know how to use your money the right way. That way you can get the best returns on your money. The other kind of education is financial tuition, and financial tuition is when you lose money by making a bad investment. I'm a real estate investor and I have read a ton of books on real estate investing, but some of the best real estate investing knowledge I got was by investing in a property, which I call my nightmare property, where I lost a ton of money. It was my education. It was the financial tuition I had to pay to learn how to be a good real estate investor, because there's just some things that you can't learn in books. There's just some things that you can't learn in courses. So that's another kind of education where you just go out and do things because there will be times when you lose money. That's just reality. By the way, if you do want to learn more about my worst real estate deal ever, it was a nightmare property. I read a lot of books that say, every real estate investor has one
really bad deal, this is mine. So I want you guys to learn from my mistakes. This is not something to teach you in business books or even something to talk about in real estate books. So I want you guys to learn from my mistakes so you don't make the same mistakes as I did, because it was very expensive. Let's take a look inside.
I walked through that deal on YouTube, and if you want to watch that video, I will also link it for you in the description below. Then you have investing in assets. This is your more traditional type of investing, because now we're talking about investing in the stock market or investing in real estate. Now you're really just putting your money to work. That way your money can attract you more money. The way it works is now you're buying an asset, you're buying an investment for the purpose of making money, because you're buying something that you think will go up in value. So if you buy a stock for $100 a share, and then this company starts to make more money and the value of your stock goes to $200 a share, now you just doubled your money. You can also put your money to work for passive income, because now certain stocks pay dividends. What dividends are cash payments. Is passive income that you get just for owning a stock that pays a dividend. It's the same with real estate. If you buy a home, you can rent out this home for $1,000 a month, and now every single month your tenants are going to pay you $1,000 a month for living in your property. And now even if you're sitting on a beach somewhere, you're still getting $1,000 a month every single month from your tenants that are living in your property, and you don't have to do any of the work because you put your money to work. You use your money to buy an asset, to buy this house, and now your money through this asset is generating you passive income. And the best part of all is now you're creating a new income stream that you're earning without having to physically go to work. Because now if you have income coming in from your stocks, or if you have income coming in from your real estate, this is money that you're getting without you going to your job. Now let me give you a quick disclaimer here, because there's a lot of kind of misconceptions out there about passive income and investing, with a lot of people on the internet saying, oh, you can become a millionaire overnight by just throwing your money in stocks or by throwing your money in real estate. Well, it doesn't really work like that. It is a slow, gradual wealth building process where the more money you put in, the better returns you will generally see, and the more time you have, the more money you will make. And that's when we come to number 5, putting fuel on the fire, where now you understand how to use your money, and now it's time to earn more money because you know how to grow your money even bigger. The reason I talk about this now, not earlier, is because a lot of people think that the solution to their money problems is just earning more money. But there's a little problem with that. If you don't know how to manage your money with $40,000 a year, you're not going to know how to manage your money suddenly at $400,000 a year, or even $4 million a year. That's why 70% of lottery winners become broke or bankrupt within just 5 years of winning the lottery. And that's why 78% of NFL players who make a ton of money while they're playing in the NFL end up broke or bankrupt within just 2 years of retiring from the NFL. Making more money does you no good unless you know how to use your money first. That's why once you know how to use your money, it's all about putting fuel on the fire, because now you have a financial system. You've built your savings cushion. You're no longer bleeding cash, and now you're putting your money to work. Once you do that, it's all about amplifying the system by earning more money and putting fuel on the fire. The way you do this is going to depend on you. For some of you, that might mean asking for a raise or working to get a promotion, something where you can get more money from your job. For others of you, maybe you're working a job, but you also really like baking cakes. If that's the case, now you can start a side hustle where on the weekends, you're baking cakes and you're selling it to your friends and your neighbors and other people that like your cake. And for others of you, you might have an entrepreneurial bug where you just really want to start a business. The whole purpose here is now when you make more money, you don't just go out and buy a fancy car. You follow your financial system. You're going 75, 15, 10, or you're going 50, 30, 20. Whenever you make more money, you're just taking that money and you're putting it into your funnel. That way you're investing more money, you're saving more money until you have the savings cushion built up, and then you're spending a little bit more money. The whole purpose of all of this is to manage your money in a way where you're paying yourself and you're building your wealth first before you go out and spend all your money and make all of those companies around you rich. Before we jump back into the video, I do want to let you know that if you are interested in learning more about how you can be a successful stock market investor, we put together a program called Stock Market Insiders, which is a weekly stock market coaching session with one of our stock market coaches, and you also get access to our exclusive community of serious investors. I have spent tens of thousands of dollars on different classes and education to learn how to be good either in my business or with my money, which were helpful. I enjoyed these classes. But one of the things that I found even more helpful than these classes where you had to do everything yourself was when I had some sort of coaching where whether it was bi-weekly coaching or monthly coaching, where I would learn from somebody and continue to stay up to date on what's going on. That way they can continue to provide me guidance in my business based off of everything that's going on right now. And that's exactly what we're trying to do with Stock Market Insiders. You get access to a weekly stock market coaching session where your stock market coaches are going to teach you a new lesson every single week, and then they'll be able to apply what you learned based on what's going on in the world right now. The most important thing to me when we were building Stock Market Insiders was our teachers, our coaches inside Stock Market Insiders, because I wanted to make sure that our insiders are learning from real stock market teachers, not just people who can put up a fake social media front. And so our coaches inside Stock Market Insiders are people that have been investing their money for years. These are people that have had great returns, and these are people that have the money to show their returns. And so we're talking about people that have at least six figures, if not millions of dollars in the market. And in order for them to be a coach, they've had to prove their success. So every week you get access to a live coaching session, you can ask your questions, and you get access to an exclusive community. And the best part is this is a very affordable program. It costs less than the price of a dinner for two, and you can try it out before you buy it. I know you're probably skeptical. I'm skeptical before I spend any money on the internet. That's why we have a free 10-day trial. That way you can try out Stock Market Insiders. You can see how it works. You can attend the live coaching call. You can join the Discord community. That way you can chat with other investors, and then you can decide if this is right for you. So if you want to learn more and see how you can get started with your free 10-day trial for Stock Market Insiders, I'll put the link to how you can do that in the description below. Knowing how much money you need in order to live financially free is one of the most important financial questions you can ask yourself. I got my handy dandy whiteboard because today I want to go over how far $1 million can actually go. How you use your $1 million is going to depend on a couple of different things. It's going to depend on how you spend your money, and it's going to depend on how you actually use your $1 million. So let's start by talking about you using $1 million to live a $1 million lifestyle. If you want to go out and live that millionaire lifestyle, then you're probably going to keep this $1 million in cash in your bank. That way you can access it very easily. And now what you're going to do is you're going to go out and you want to look good on Instagram. So you're going to buy yourself, let's say, a $500,000 house with cash. That way you don't have to deal with any mortgage payments. And then you're going to buy yourself a nice $200,000, maybe an Audi R8, a nice supercar. You're going to go on a few vacations. So there's a plane, looks like a plane. And in a couple of years, you are going to be broke. So if you want to live the Instagram flexing lifestyle, then the $1 million is not going to last you very long. This should be pretty obvious. If you're subscribed to a YouTube channel, you understand that it doesn't really matter how much money you make that matters. It's what you do with the money you make. Even if you have $1 million, you can go broke almost instantly if you don't know how to use your money the right way. And if you're not subscribed to a YouTube channel, you should do that. But this is why so many high-paid athletes and so many high-paid lottery winners end up broke so quickly, is because you make a ton of money, but you don't have any financial education. So what do you do when you make a lot of money? You blow it. Now, when you blow all this money you have a bunch of nice things, but you have no money left. This is the majority mindset way of spending money. You make a ton of money and then you blow it on a bunch of nice things that make you look rich, but they keep you broke. And so this is going to be a big no-no when you make $1 million. Now, don't get me wrong. I want you to own a nice home, and I want you to drive a nice car, and I want you to go on nice vacations, but I want to make sure you can afford it. That way you have cash to live your life financially free. So let's go into the second way that you can use your money. Now let's assume that you have this $1 million, but you're conservative. You don't like the whole idea of investing your money because you don't want to throw your money in the stock market and see this $1 million get sliced in half if the stock market crashes. So you want to be safe and you just put this money in the bank. This is how I grew up learning about money. I grew up in a traditional Indian house, and Indian people love saving money. It is like in our blood. And so Indian people make $1 to spend 20 cents and save 80 cents. Well, in the American culture, it is very common to make $1 and then spend $1.20 with lines of credit and credit cards and loans. And so Indian people are born with that saving mentality. And so what do? You make money and then you save as much money as possible, and you don't want to invest it because investing is risky. And so you build this huge savings cushion. That way you can live wealthy. Now, saving your money is better than blowing all of your money on nice cars and clothes, but it doesn't give you the full potential of your money because your money is just sitting there flat and is getting eaten away by inflation. In the financial world, there is something called the 4% rule, which says you take your savings and investments and you add it up, and then you live off of 4% of that a year and you adjust it for inflation. So in this example, I'm going to take a modified version of this 4% rule and say that you want to live off of just $40,000 a year, which is 4% of your $1 million you saved up in cash. If you live off of $40,000 a year, then this $1 million is gonna last you 25 years because now you're not investing your money. This $1 million is just sitting in your bank account, and every single year you're just gonna draw out $40,000. So January 1st every year you draw out $40,000 and you live off of the $40,000 for 12 months. If you continue to do that, you will be able to live off of your $1 million for 25 years. After 25 years, you're not gonna have any more money. I'm assuming for the sake of this example that this $1 million is just sitting in your bank account and it's not growing at all because right now, savings accounts are not paying you anything. So if your $1 million is not growing and you're just pulling out $40,000 a year, then you will be able to live off of this money for 25 years and you will be living a $40,000 a year lifestyle. But this doesn't factor in inflation because as you know, the value of our money doesn't stay the same. That's why $100 today can't buy as much as $100 could back in 1970 because our money is slowly losing value over time because of inflation. Now, if we factor inflation into this, and now you're not pulling out $40,000 every single year, you pull out $40,000 this year, and then you pull out a little bit more money next year, and then a little bit more money after that by factoring in a 2% inflation rate. Now, you're not gonna have enough money to live off of this $1 million for 25 years. You're gonna have enough money to live off of for 21 years. So if you want to live a $40,000 lifestyle, then you can expect this money to last you for 21 to 25 years, depending on what inflation is, if you have $1 million. Now, if you want to live a $100,000 a year lifestyle, you can just adjust the numbers. So if your goal is just to save your money that you can draw cash out of, well, now you can do the math to see how long this money is going to actually last you. Now, this time, instead of saving your cash, let's say you have the minority mindset where you invest your cash and you want passive income. So you invest your money in the stock market for dividends. And I'm going to give you two different scenarios. Scenario one, you invest it in McDonald's, MCD, or you invest it in IBM. So scenario one, you invest all $1 million into McDonald's, and scenario two, you invest all $1 million into IBM. Now, look, I am just a random guy on YouTube, okay? So don't blindly listen to anything I say and make sure you do your own research. I do not recommend that you take all of your cash and throw it into one stock just because of the dividend. This is just a hypothetical. Some companies in the stock market, like McDonald's and IBM at the time of me recording this video, make a lot of money. And at the end of the year, they have a whole bunch of cash in their bank account and they just don't know how to invest all this money back into their business. And so what they do is they take this cash and they just give it away to their investors, people like you who invest in their stock. So if you go out and you invest in one share of McDonald's or one share of IBM, then you will get these passive income checks called dividends deposited directly into your account. At the time of me recording this video, McDonald's pays a 2.5% dividend, which means if you invest $1 million into the McDonald's stock, you will make $25,000 a year from your McDonald's investment. IBM, on the other hand, pays out around a 5% dividend yield right now, which means if you invest $1 million into IBM, you will make $50,000 a year in passive income from dividends. So you still own your investment, but every year you're getting a check from McDonald's or from IBM for doing nothing except just owning their stock. So you don't have to sell your stock to get these dividend checks. You just own the stock, and then every 3 months, every quarter, you are going to get a check from McDonald's or IBM. Before you go out and you start living this $50,000 or $25,000 a year lifestyle from your passive income, remember, the government wants their cut, so you gotta pay taxes. Luckily, dividend income has a lower tax rate because the government wants to incentivize you to invest your money and get this type of passive income, so they reward you with lower taxes. If you make between $0 and $40,000 a year in taxable income at the time of me recording this video, you have to pay 0% of your money in taxes. If you make between $40,000 and $441,000 a year in taxable income, then on your dividends, you have to pay 15% in taxes. And if you make more than $441,000 a year, then you are paying 20% a year in taxes on your dividends. At this point, you might be thinking, why in the world would anybody want to invest in McDonald's where you can only make a 2.5% dividend when you can invest in IBM and make a 5% annual dividend? Well, there's a little bit more to what meets the eye. Over the last 2 decades or so, the price of IBM stock has stayed pretty much flat, and over the last decade, the last 10 years, IBM stock has actually come down about 10%. So if you invested this $1 million into IBM, it hasn't really gone anywhere, and if anything, if you invested over the last decade, it has come down, even though you're making more money in dividends here. With McDonald's, on the other hand, the price of their stock has gone up 5-fold over the last couple decades, and over the last decade, the price of the stock has doubled. So if you invested this $1 million into McDonald's a decade ago, this would be worth about $2 million, and if you invested into them 5 years ago, this would be worth about $5 million, even though your dividends aren't as big. So you have to understand there's a little bit more to what meets the eye, because there's more to investing than just the dividend price, which is why you do not want to make your investment decisions based solely on this dividend percentage. You want to look at the underlying fundamentals of the company, and you want to make sure you're investing in a company that's growing, that you believe in for the future, because if you do that, then you're going to make a whole lot more money than just this dividend price. Now, past performance does not predict the future performance in any way, but I just want you to understand this, because if you invested $1 million here versus $1 million here, then you are going to make less money in passive income for a little while here, but you could also pull some of your stock out and sell some of your stock and have some cash and still see the stock growth and still see the value of your $1 million grow while having more cash in your hand. In any case, with both of these examples, you have income that you can use to live off of every single year, and you also still have this $1 million nest egg. Now, if the price of the stock goes down, the value of your investment will go down too, but in general, you still have a big chunk of your investment just sitting there invested in one of these companies, and you also have passive income that you can live off of without selling any of your investment. The third thing that you can do with this money is you say, you know what, I don't want to invest my money for dividends, I want to invest my money in the stock market to see my money grow, but I don't know which stock to put my company in, so I'm just going to put my money in the stock market, and if the stock market goes up, my $1 million will go up, and if the stock market goes down, well, I will take that risk. And now what you're planning on doing is taking out a little bit of your profits every single year, or taking out a little bit of your equity rather every single year. And if you have profits, then that's just icing on the top. Now, instead of just keeping your money in cash in the bank, you're putting your money to work by putting it into something like VOO or SPY. These are two funds that give you exposure to the broader stock market. VOO and SPY both give you exposure to the top 500 companies in the stock market. So now if the stock market goes up, your fund will go up, and if the stock market goes down, your fund generally goes down. You can draw cash out just like you could in the bank, but now you have a little bit more risk, because if the stock market goes down, the value of your $1 million will go down too. To put some numbers on this for context, in December of 2010, VOO was trading for around $110 a share, and SPY was trading for around $125 a share. Then in December 2020, 1 decade later, VOO went from $100 a share to around $340 a share, and SPY went up to $375 a share. So both of these funds saw right around a 300% increase over 1 decade between December 2010 and December 2020. What this tells us is if you put $1 million here or here in December 2010, you would have something around $3 million over here. But the issue with that is then you don't have any money to live off of for this decade. So if you live off of 6% of your income now, so meaning in 2010, you take $60,000 out. So now you have $940,000 to invest, and you put it here or here, you would still see a profitable growth. That means now you're not taking out 4% like I talked about before, you're taking out $60,000 or 6% of whatever your pool is every single year, and you're still seeing a profitable growth because you're seeing more than a 10% growth on your money year after year after year. So you're pulling out 6%, but your money is growing by 10%, so although you're taking out more money than before, your money is still growing faster than what you're pulling out. In this situation, you have a couple benefits. You get to pull out more cash than you did before, so you can live a bigger lifestyle, and you still have your nest egg, and your nest egg is growing on top of that. Before, when you just saved $1 million, every time you pulled money out, your nest egg grew smaller, so you had less and less cash available. Now you're pulling more money out, but your nest egg keeps growing bigger. Now I know you're probably thinking, but just because the stock market went up in the past doesn't mean it's going to continue to go up at the same rate in the future. You're 100% right. Maybe the stock market will go down. Maybe it will stay flat. Maybe it will go up faster than this. Maybe it'll go up slower than this. There's no way to predict that, but this is the risk you take from you investing your money. And that's also why more risk comes with more potential reward. Now, I should also mention that when you pull out cash in this situation, when you sell your stock and you have a profit, you have to pay taxes on your profits. That doesn't mean you pay taxes on every dollar you pull out, because some of this money, this $1 million, is yours. So when you pull this $1 million out, you don't pay any taxes. There's lower tax rates that I talked about earlier. If you don't like the idea of owning these paper investments like stocks, and you want to own a tangible physical investment that you can see that will pay you passive income, then you can look into investing in real estate. So real estate is my favorite investment class just because I like the idea of creating passive income through owning a physical asset. I'm trying to draw an apartment complex here, so bear with me. I hope that looks like an apartment. But when you buy an investment like real estate, now you own something physical that you can see, feel, and touch, like this property. And now what your goal is to own this property and put tenants, people, into this property who are going to live there or use your property, and in exchange for them using your property, they're going to pay you rent every single month. So you don't have to do any physical work to earn this income, because once you own the asset, you can hire a management company or a property manager to do all the physical day-to-day work, but you will get this passive income every single month because people are living in or using your property, and for them to do that, they have to pay you rent. When I invest in real estate, my goal is to get a minimum 7% annual return on my money. So if you invest $1 million into a property, let's say you buy a small apartment complex, then my goal would be to make $70,000 a year in passive income profits after paying all your expenses from owning this property. So after paying all your expenses, you should be left with $70,000 in your bank account. At first glance, you're making the most money here, but don't forget about taxes, because you got to pay taxes on your income. Now, as an attorney, I can tell you that real estate has a bunch of legal tax loopholes that you can use. Now, although I am an attorney, I am not your attorney, so if you have specific tax questions, make sure you talk to a tax specialist in your area. Now, what you can do with real estate here is you could tell the government, hey, yeah, I made $70,000, but I don't want to pay taxes on all $70,000 because my property is a year older. And so what you get to do if you have a $1 million property is you get to take a $25,000 deduction every single year for the next 30 or so years, because the property that you own is just 1 year older. And so you get to tell the government, I'm only going to pay taxes on $45,000, even though I made $70,000, because you get to take this deduction called the depreciation deduction every single year for just under 30 years because you are investing in real estate. And that's just one of the loopholes you get for investing in real estate. So if we calculate this out, if you tell the IRS that you made $45,000 in income from your real estate property, you're going to have to pay around $5,000 in taxes, because you don't have to pay Social Security taxes or Medicare taxes. You only have to pay your income taxes, which means you are going to be left with right around $65,000. You made $70,000, you only pay taxes on $45,000, and you will be left with about $65,000 that you can use to live your life, and you still own this $1 million property. Now, there are some other legal loopholes that you can use in real estate to lower your taxable income even lower, but I'm not going to go over all of that in this video. Hopefully, you'll see your property value go up, which will add some icing on top of this passive income. But when I analyze my real estate investment deals, I'm looking at this, the passive income. I'm not looking at what potential value this could go up to, because I just want to see how much money I can make every single month. As a quick little tip on this, real estate does have more risk, because now you have to physically manage this property and deal with tenants and work with property managers and work with real estate agents and work with contractors. So there's more upfront work required, and there's more of kind of like a skill set required, because now you're not just investing in a company like McDonald's and IBM and letting them handle the investment. You are the one managing your investment here. So now if we really analyze how far $1 million can take you, it depends on how you use your cash. If you just save the $1 million, that means you will be able to live off of, let's say, $40,000 a year, and you have 21 to 25 years of money. After the 21 to 25 years, your money is gone and you have no money left. If you invest this money into dividend-paying stocks like the McDonald's or IBM that we discussed, then you can expect to make somewhere between $25,000 and $50,000 a year to live off of, based on today's numbers. And this will last you as long as the company is strong, because now you're owning an investment that will continue to pay you dividends as long as the economy is strong and as long as the company that you're investing in is making money. If you invested this money into an index like VOO or SPY that gives you exposure to the general stock market, then we're talking about something like $60,000 a year based off of the historical numbers that we saw. And again, how long will this last? Well, as long as the economy is growing and the stock market is growing. These come with more risk than this, but there's more potential to make more money. And if you invest this money into real estate, then hopefully, depending on where you live, you should be able to make about $70,000 a year in passive income. Again, these are all pre-tax numbers. And how long will this last you? Well, it depends on how good the area is that you invest in. If the location continues to thrive, then you will be able to make money from that property for generations. But if the area that you're investing in starts to tank and people move away, then you might not continue to see the same rental income that you're seeing right now. The people who never learn the rules of money will always be ruled by money, which is why you, who, me? Yes, you need to learn the rules of money. The 10 laws of money that I'm gonna go over today are not things that you can just find in a textbook somewhere. These are things that I learned from starting and running my own business, from investing, and most importantly, making a whole lot of expensive mistakes. Money law number 1. Money is emotionless. Having money doesn't make you an evil person, and having money doesn't make you a good person. Having money just gives you fuel for your life. And you, as the controller of your fuel, get to decide how you want to use your fuel. Your money is emotionless. It doesn't care what you tell it to do. Aw, I didn't mean to hurt your feelings, Benji. Your money does whatever you tell it to do. If you want to be an a-hole, hey, having money will let you be an even bigger a-hole. If you love serving meals to hungry people, having money will let you serve even more meals. Money law number 2. Money does not reward hard work. If money rewarded hard work, then the highest paid people would be the construction workers, the laborers, and the people working retail and restaurant jobs. Newsflash, they're not. If you work as a consultant making $100,000 a year and you work 10 hours a day and you wanted to make more money, you could work harder at your job, and now you might be working 15 hours a day and you might get a 10% or a 20% pay bump if you're lucky. You're working really, really hard to make more, but you're only marginally making more money. But at the same time, your boss might be making 10 times more than you, but they're not working any harder. It's because money does not reward hard work. Money rewards unique value creation. But this is where things get tricky, because if you want to create a whole lot of unique value, you need to work really, really hard to create this unique value. But the difference here is now you're working hard to create more unique value where you have an unlimited earning potential, versus before you were working hard to make more money where you only have a marginal return. Money law number 3. Money hates sitting still. The Federal Reserve Bank can print money 1,000,000 times faster than you can work for it. When you make your money sit still, it's becoming less and less valuable. Your money would much rather be out working, attracting you friends, and making you more money. Ulysses, meet your new friend, Ben. That's why money goes to people who know how to use their money. Like when you go shopping, the business owner is the one making money because they use their money to buy things that will make them money, versus you're using your money to buy things that will lose you money. And when you save your money in the bank, you are forcing your money to sit still. Don't move, Benji. That's when your bank comes in and says, okay, you are abusing your money, so we're gonna come in and we're gonna use your money for you because your money hates sitting still and you don't know how to use your money. That's when your bank comes in and they take that $1,000 or whatever you deposited in your savings account, and they turn around and they loan your savings to John so that way he can get a mortgage, or so he can get a line of credit, or so he can get a credit card. Now your money is working really hard for your bank, attracting them a lot of money through interest, while you get next to nothing because you wanted to abuse your money. And this brings me to money law number 4. With no risk comes no return. If you want to be wealthy, you need to ask yourself 2 things. 1, what are my life goals? And 2, how fast can I double my money? And then see if these answers align. If you start off with $10,000 and you double it, you have $20,000, double that, $40,000, double that, $80,000, double that, $160,000, double that a few more times, you're at $1.28 million. And now every time you double your money, you are making millions. The faster you can double your money, the more wealth, and the more freedom you will have. But this is where your risk needs to align with your life goals. When you save all of your money in a savings account paying 0.05% a year, it will take you 138 years for your money to double. Your money isn't going anywhere and you will never achieve your goals. If you put your money into a high interest rate CD, certificate of deposit paying 2.5% a year, it will take you 28 years to double your money. Still, nothing significant or meaningful is going to come out of this. If you invest your money in stocks or real estate and you can get a 10% return a year, now you can double your money every 7 years. And now we're talking, because now you can double your money 7 times over your lifetime. If you started off with $10,000 over a lifetime, you could end up with over 10 million. If you start your own business, now you are physically working to grow your money and you can see returns of 30 to 100% a year. If you just stick with the lower amount, 30% a year, now your money will be doubling every 2.6 years. And so what took you a lifetime to do here, you could do in 30 years. The further you go down this list, the better your returns are, but it comes with more risk. When you put your money in your savings account, you got no risk. You give your money to the bank and you can access your money whenever you want, but that's why you get no reward, no returns. When you put your money into a CD, now your money is tied up for a few years, which is why you get a better return, but it's still nothing meaningful. Now, when you invest your money into the stock market or in real estate, now you can get a better return on your money, but you can also lose money a lot easier because this comes with more return. And when you start your own business, now you have to invest your time and your money to grow a business with no guarantees, but you have the highest potential. You need to ask yourself what kind of life you want to live and make sure that your risk is aligning with your life goals. Money law number 5. Money is a game. If you wanted to be a good basketball player, you have to learn the rules of the game and then you have to practice until you can make free throws with your eyes closed. Money works the same way. It's just a game. If I bring back this chart, the good news is all of this can be learned. This is what financial education is. You probably didn't have a class on this in school, but this can be learned. If you want to get good at these games, you got to learn the rules, practice, make mistakes, and get better. Money law number 6. Negative minds repel money. If you wanted to repel Superman, all you need is some kryptonite. And if you just want to repel money, all you need is a negative mind. When you criticize somebody else's success, you're not hurting them. They're successful, they're doing their thing, and they're not going to stop being successful because you're upset. But you are stopping yourself from becoming successful when you criticize success. And that's not all. You will 100%, without a doubt, never become successful if you tell yourself you cannot do it. You can't do it, Jaspreet. When you tell yourself you can't do something, your brain shuts off and it will stop trying, which is why instead of saying you can't do something, ask yourself, how can I do something? Money law number 7. What you're worth on paper is not what you're worth in cash. The cash in your hand is how much money you can spend today without selling any of your assets and without selling any of your investments. The amount of money you're worth on paper is how much you think you're worth based on the assets that you own. Just because your stock portfolio is worth $1 million today doesn't mean it'll be worth $1 million tomorrow. So what does this mean? It means you should absolutely not live a lifestyle based off of what you think you're worth on paper. You should be living a lifestyle based off of how much cash you have in your hand. I cannot tell you the number of business people that I have worked with that start living these huge lavish lifestyles because of what they think they're worth on paper. And then when things go wrong, these are also the first people in line to lose their shirts. Money law number 8. Protect your assets. I'm an attorney, and as an attorney, I can tell you that when people see you have money, they will try to take their hand, put it in your pocket, and take some of your money from you just because they see you got it. Get insurance, use legal shields, hire an attorney, and hire a tax professional to help you with your taxes because you want to keep your wallet for yourself instead of sharing it with the whole world. Hey, get your hands off my wallet! Money law number 9. Act your wage. Everyone on Instagram has a Nissan GTR, a Lambo, or a Porsche. At least that's what it feels like. But just because you can buy it doesn't mean you can afford it. If you cannot buy your car with cash, you cannot afford it. Sorry, fake Instagram flexers. And when it comes to buying a car for the show, so I'm talking about luxury and exotic cars here, if you cannot buy 5 of them with cash, you cannot afford 1 of them. Oh, then I'm gonna need a lot of money before I can buy a Lambo. Yeah, that's the point. When I was finally starting to see some success as an entrepreneur, I really wanted to go out and buy a brand new Beamer. And all of my friends around me kept saying, Jaspreet, go buy the BMW. It will look sweet. It would have cost me like $50,000, which I had ready to go. But do you know what $50,000 can do when you're starting off as an entrepreneur or starting a business? $50,000 is a full-time employee's salary. $50,000 is rent for a year. $50,000 is a new software that can make us more money. There's nothing wrong with buying nice things or buying luxury things, but you should only be buying luxury when you can afford to buy it without worrying about the price tag. And money law number 10. Diversification isn't always the right answer. You've probably heard people say that millionaires have 7 streams of income. But what you're missing at the end of that statement is that the millionaire didn't become a millionaire because they had 7 streams of income. They became a millionaire because they mastered one thing. And once they figured this one thing out, that's when they moved on to 2. And once they mastered the second, that's when they moved on to 3. If you try to do 7 things at once because you think that's what millionaires do, so you try to start a business, you try to start lending money to your cousin, try to start flipping real estate, you try to start the Shopify business, you will go nowhere. Be the master of 1 first, and once you dominate that, then move on to 2. Our cash loses value every single day. Yet after the 2008 crash, interest rates have been dirt cheap, so people and businesses were able to borrow money for almost free. When cash is easy to come by, it's easy to believe that cash is trash because why in the world would you save cash when the Fed can just print it 1,000,000,000,000 times faster than you can save it? By the way, in this video, when I say and when people say cash is trash, I don't mean that people will actually take their cash and just throw it in the garbage. It means that your cash is losing value, so it is better for you to invest your cash instead of actually just keeping it in your pocket. Oh, well, I'm glad you told me that. Prior to this pandemic, if businesses had more than just 1 month's worth of cash in their bank account, it was almost considered bad business practice because you were stifling growth by saving your money. So investors and board members were pressuring businesses to save as little cash as possible and invest this money back into their business because if you really needed to buy anything, you could just finance it. I mean, what would you save your money for anyways? A pandemic? Oh, greedy businesses need to learn how to manage their money. Yeah, well, people operated the same way. 0% APR became so popular over the last decade because no one actually had savings to buy a cell phone outright, so they would finance it. And then they'd finance their car and their furniture and their clothes. Now we have this culture in America where people go to work just to pay your bills and hopefully you'll have enough cash left over to buy some extra guac at Chipotle. Just wait until I can finance my guac. Shh. Almost every person and business in the United States lived off of credit, which was no big deal when things were good. But then came this pandemic out of nowhere and the economy suddenly stopped and money stopped flowing. So now everybody had these expenses to pay, but there was no money coming in. So the government and the Federal Reserve Bank had to print trillions of dollars and pump this money into the economy to keep the thing moving artificially. And that's why cash is king until it becomes trash. You need to have savings, okay? I don't care how bad interest rates are. You need to have some cash saved up to protect you from an emergency. But you do not want to save all your cash. Your goal should be to save 6 months worth of expenses in cash in a savings account. So if you spend $5,000 a month, that means you need $30,000 in a savings account. This $30,000 is not your down payment for a new house, and it's not your new car fund. This $30,000 is your crisis fund. After you got your savings in check, cash becomes trash. Now, the only reason why you should be saving money from here on out should be to either save for a big purchase or save to make an investment. You should not be saving your money just to save it, and you should hit that thumbs up button below, because if you don't, then YouTube doesn't share our video with anybody else. I wasn't supposed to be on YouTube. I was supposed to be a doctor like all of my Indian friends, but I kind of took a different path. However, I know quite a few doctors, and a few doctors have talked to me about how they have $1 million or more sitting in their bank account. This $1 million that they have isn't a down payment that they're saving up for a house, and it's not there to be used as an investment. Their cash is just sitting there in their bank account because they don't know what to do with their cash. Now, saving $1 million is better than going to Gucci and buying up everything. Although $1 million will probably only buy you like one shelf. But there's so much more that you can do with your money. Like if you're 40 years old and you have $1 million in your bank account, well, by the time you retire, that $1 million is gonna have only the buying power that $500,000 does today. That's what inflation does. The value of each dollar you have comes down while the price of everything around you goes up. The money you have in your bank account isn't growing. Like if you have $100,000 and it's sitting in a traditional bank account, after 10 years, you're gonna have $100,000 and some change, while your rent, your groceries, your extra guac keeps becoming more and more expensive. At this point, everybody says something like, well, Warren Buffett has over $100 billion saved in cash. What do you gotta say about that, Jaspreet? Yeah, you're right. Warren Buffett is sitting on billions of dollars of cash. But that isn't his personal savings account. That savings that you're talking about is his investment fund that he's waiting to use when he finds a good investment deal that comes his way. It's not just cash that he wants to just sit there. He wants to invest that money, but he's waiting for a good investment. Warren Buffett talks openly about how he hates holding cash. Remember what I said before, cash is king until it becomes trash. You need to build your savings cushion, but after you build your savings, after that, cash becomes trash, so you want to invest as much cash as you can after that. Every dollar you make needs to have a job. Either it's a spending dollar, it's an investing dollar, or it's a saving dollar. We already talked about your savings money. You want to save 6 months worth of expenses into your savings fund, your savings bucket. Once that's full, you should only be adding more money into your savings if your monthly expenses go up, or if you have to pull some of the savings money out to fund a crisis. Once that's full, you want to be doubling down on your investments. Your investment money is the money that you're investing, whether you're buying stocks or real estate or commodities, whatever. You don't have to go out and spend all of your investment money today, but you need to know that this is the money that you're going to be investing and that you're looking for deals to buy. Like the people who had cash ready were able to buy stocks at a huge discount when the Dow Jones fell below 19,000 points in March. The people that didn't have an investment fund couldn't. No investor wants to hold cash in their investment fund forever because your cash is losing value. But I also don't like overpaying for my investments. Like I made a video back in February of 2020 where I talked about how I was selling some of my investments and how I was holding on to more cash because things just weren't making sense in the economy and the stock market was right around record highs. I'm not gonna lie, I got pretty lucky with my timing. Like I didn't predict that this pandemic was gonna completely shut down our economy and put our stock market and economy in free fall in March just 1 month later. But this gave me the cash that I could use to buy more stocks in March when the stock market was in free fall. So I had more cash waiting to be invested, and then when I found a deal, I spent this cash on my investments because I would rather have cash flow than hold on to cash. After you got your savings in check, you should only be saving to buy something or to make an investment. Cash flow is the income you get for owning investments. And so what I do is I start filling up my investment bucket, and then I start looking for investment deals. And as soon as I find an investment deal, I take this cash from my investment bucket and then I spend it to buy this investment deal. This is why I say cash is king until it becomes trash. You need to have your savings, okay? But once you have your savings, now your cash can do so much more than just sitting in your bank account collecting dust. But things get a little bit trickier when it comes to a business's finances, and this is something you need to understand even if you don't plan on running a business, because if you're investing in stocks, you are investing in businesses. Managing a business's finances is hard. I can tell you from personal experience because I'm still trying to figure it out. I run a financial news and education company, and we have a lot of expenses. Rent, salaries, softwares. We don't have any investors or outside capital, so our business has to make $1 before we can spend $1. And that's why a savings cushion is so important for us. Right now, I've been following the 6-month model where our business keeps 6 months worth of expenses in cash. That way, in case an emergency happens or a crisis happens, our business can continue to operate even if we don't earn another penny for the next 6 months without even slowing down. On one hand, maybe this isn't enough. Bill Gates talks about when he was building Microsoft, it was his goal to keep 1 year's worth of expenses in cash in his company's bank account, because if the economy slowed down or the business slowed down, he didn't want to have to stress about shrinking the business, and he could keep the business going for a whole year even if he didn't make a penny during that year. On the flip side, the more you save, the slower you grow, because if you're saving cash, that means you're having cash sit in your bank account that you could be using to help grow your business. But naturally, that comes with more risk. Yeah, you can grow a whole lot faster because you're not saving any of your money, but if the economy slows down or we run into a pandemic like we're seeing right now, then you have to start firing people immediately to start saving cash. There's no one right way to do it. Businesses with both philosophies have succeeded, so if you're investing in companies, you want to make sure that this company follows a philosophy that you agree with. And this is what financial education is all about. Understanding how money works so you can use your money as a tool to help build your wealth. Before we jump back into the video, I do want to let you know that if you are interested in learning more about how you can be a successful stock market investor, we put together a program called Stock Market Insiders, which is a weekly stock market coaching session with one of our stock market coaches, and you also get access to our exclusive community of serious investors. I have spent tens of thousands of dollars on different classes and education to learn how to be good either in my business or with my money, which were helpful. I enjoyed these classes. But one of the things that I found even more helpful than these classes where you had to do everything yourself was when I had some sort of coaching, where whether it was bi-weekly coaching or monthly coaching, where I would learn from somebody and continue to stay up to date on what's going on. That way they can continue to provide me guidance in my business based off of everything that's going on right now. And that's exactly what we're trying to do with Stock Market Insiders. You get access to a weekly stock market coaching session where your stock market coaches are going to teach you a new lesson every single week, and then they'll be able to apply what you learned based on what's going on in the world right now. The most important thing to me when we were building Stock Market Insiders was our teachers, our coaches inside Stock Market Insiders, because I wanted to make sure that our insiders are learning from real stock market teachers, not just people who can put up a fake social media front. And so our coaches inside Stock Market Insiders are people that have been investing their money for years. These are people that have had great returns, and these are people that have the money to show their returns. And so we're talking about people that have at least 6 figures, if not millions of dollars in the market. And in order for them to be a coach, they've had to prove their success. So every week you get access to a live coaching session, you can ask your questions, and you get access to an exclusive community. And the best part is this is a very affordable program. It costs less than the price of a dinner for 2, and you can try it out before you buy it. I know you're probably skeptical. I'm skeptical before I spend any money on the internet. That's why we have a free 10-day trial. That way you can try out Stock Market Insiders. You can see how it works. You can attend the live coaching call. You can join the Discord community. That way you can chat with other investors, and then you can decide if this is right for you. So if you want to learn more and see how you can get started with your free 10-day trial for Stock Market Insiders, I'll put the link to how you can do that in the description below. Let's talk about money for a second, okay? Because the majority of people are spending their lives chasing money, but they have no idea of how money really plays a part in their lives. So money, this cash is just paper. This paper honestly has no value unless you use it. That's what people actually want. It's not the money that people really are after, it's what money can buy you. But one thing that so many people get confused and why so many people are miserable is because they don't understand how and when and why money plays a part in their lives. Money is important, okay? We are not one of those theoretical channels that just talk about things that don't make any sense in reality because you need money in order to survive. Anybody who tells you money is not important is either broke or they're delusional. Money is what buys your kids clothes. Money is what buys you food. Money is what puts a roof over your head, and money is what buys your car. Now, while money is important, it is not the only thing that matters in life. And this is where so many people get confused because they don't really understand where and how much to value money in their life. Let me draw you a little triangle. I call this my quadruped theory. If you're subscribed to our YouTube channel, you might have heard me talk about this before. This quadruped triangle really will help you understand how money really plays a part in your life. So this you could think of kind of as what are the building blocks of living a happy life, because at the end of the day, the goal is to be happy, not rich. If you are rich and miserable, what's the point, right? But at the bottom of this quadruped triangle is physical fitness. If you want to live a good life, the very first thing you have to do is be physically fit, okay? If you are on your deathbed, if you are so morbidly obese that you cannot live your life, if you are not physically healthy to the point where you cannot live your life, nothing else matters. If you're on your deathbed, it does not matter if you have $10 million in your bank account. It does not matter. When you are sick, when you are hurt, the only thing that you want is to be healthy. When you are healthy, you can have a million desires, you can have a million missions, you can have a million dreams, and you can work towards these things. But if you're not physically healthy, nothing matters because you can't even start working towards these things. So the very first thing you have to do, if you want to be able to enjoy money and enjoy your life and live happy, is you have to be physically fit. If you are physically fit, then you can start moving up this quadruped triangle and move to the second building block, which is mental fitness. This is something that is now starting to really get some attention, which is good news, but mental health is a real thing, okay? If you are not happy, if you are miserable, if you are depressed, nothing else matters. It doesn't matter if you have $1 million in your bank account if you are depressed and miserable because you won't be able to enjoy it. Okay, the first thing you need to do before you can get there after you're physically fit is make sure you are mentally fit too. Surround yourself with people that love you. Work on things, find things that make you happy. If you are not happy, it doesn't matter how much money you have. You are not going to be able to enjoy it because you are not mentally healthy. Now there are resources available for you out there. If you are really depressed, you have a lot of anxiety, you cannot live your life, talk to a therapist. There are resources for you out there. But if you are not mentally fit, you will not be able to enjoy money or enjoy your life. Okay, this is why everybody says money can't buy happiness, because a lot of people are hurting right down here. They think, oh, I have this void in my life. I am not happy, but if I just had $1 million, then I'd be happy. And then you get that $1 million and then you realize, oh, I'm more miserable now than before because money fuels you. If you are unhappy, more money is going to make you more unhappy. Once you are physically fit and you are mentally fit, then you can move on to the third block, which is spiritually fit. Now, being spiritually fit doesn't mean religious. Being spiritually fit means having a purpose in life. What is the reason you are on this earth for? Why do you get up every morning? What is your purpose? That's what being spiritually fit is, okay? So once you're physically healthy, you have a good life, you have a good body. Once you're mentally healthy, you have a good mind. Now you can work on finding your purpose. What is your reason for being on this earth? This is what being spiritually fit is all about. If you do not have the spiritual fitness, then you are just kind of just flying through the world like a plastic bag. You don't know why you're here and you don't have a reason to get out of bed. But if you have a reason to get out of bed every single morning, now you have this kind of this drive to just conquer the world. And this is what helps people live that happy life. If you don't have the spiritual fitness, it doesn't matter how much money you have, you're gonna feel like you have no purpose in life. Once you're physically fit, and then you're mentally fit, and then you're spiritually fit, that's where money plays a part. Everybody says money cannot buy happiness because they assume that people are gonna make money here to either make up for the lack of spiritual fitness, the lack of their mental fitness, or the lack of their physical fitness. This is where money cannot buy happiness because yeah, you cannot use money to make up for a void in one of these things. And this is what so many people try to do. They think, oh yeah, I'm not healthy, but if I was rich, things would be better. Or yeah, I'm not happy, but if I was rich, then I'd have more friends. Or yeah, I have no purpose, but maybe if I'm rich, I'll feel like I have a purpose. But that's not how it works. Money and financial fitness helps you here. It helps you be financially fit, nothing else. That's why if you want to live a great life and you want to live a rich life, you need to understand how money plays a part in your life and where money plays a part in your life. Because in order to really enjoy this money that you have, you need to make sure you have the building blocks first. I can't tell you how many people I know, and I'm sure you know people like this too, that are lacking either here or here. They are not happy in their life for one reason or another, or they feel like they have no purpose, yet they're sitting here chasing money, just trying to get more money, thinking and hoping that having more money will compensate for these two things. It doesn't work like that. I'm sure you've heard of people that are rich, millionaires and billionaires that are miserable. Well, why does that happen? It's because they're lacking here, here, or here, and then they're trying to use money to make up for the other parts of their life. Having more money helps with the financial part of your life. That's it. And then once you do have more money and you have these building blocks, then you can use this money to amplify these things. You can use your money to improve your physical fitness. You can use your money to do more things that make you happy. You can use your money to help serve your purpose. But if you don't have these things, then this money is just going to help amplify that void, because money is fuel. It amplifies who you are. If you are a bad person and you are miserable and you have more money, now you're going to be more miserable and you have a tool, this money, to do more bad deeds. If you are a good person and you're happy and you have more money, now you have a tool, this money, to do more things that make you happy, and you have a tool to do more good. Our brand talks so much about financial education because the reality is money does play a part in our lives. Yeah, many of us don't understand where or how, but money is important. But at the same time, many of us are never taught how to use money and understand money the right way. And in our culture and society, it's just almost like taboo to talk about money. It was the same way for me. When I was growing up, I was always told, don't talk about money, don't worry about money, don't think about money like that because it's bad. But I was also told to go and become a doctor, because for my parents and a lot of my family, the richest people that they knew and the most successful people that they knew were doctors. So they assumed, okay, if you go and become a doctor, then you'll be able to become successful and then you can live a great life. But things just didn't add up for me. If money doesn't matter, you're not supposed to talk about money, why do I have to go and become a doctor to earn this high salary when money isn't that important? Many of us create these smoke screens in our lives. We say things like money doesn't matter, or don't talk about money, or money is bad because we don't have money ourselves and we don't understand why we don't have it. And so we just say, oh, don't worry about money, as kind of this smoke screen to cover up our financial issues. We need doctors. But I realized that I was going down this medical route, pre-med route, when I was in middle school and high school and college for all the wrong reasons. You should become a doctor because you want to be a doctor, not because of the salary. That's just one of the perks of being a doctor and having the value that you have. That's when I had to start asking myself, okay, how do I get that doctor financial freedom? Because everybody thinks doctors are financially free and rich, when there's a lot more to the story than that, but that's what everybody thinks, right? And that's what I thought too. How do you get that doctor financial freedom without being the doctor? Oh, you just work on the financial freedom. That's when I dove into entrepreneurship and I started an event planning business in college, because I thought, okay, now if I make this money, I can work towards being financially free. The problem was I didn't like what I was doing. I don't drink, I don't smoke, I'm not into the party business, but I was hosting parties every single week, and a few years into it, I got burned out. The business was making great money, but I just didn't like doing it. The business failed, but I did it. Yeah, we made good money, but beyond that, I learned a lot. I learned how business worked. I learned how to get customers. I learned how to sell. I learned how to market. And even more importantly than that, I learned how money really plays a part in our lives. Life is like a cake and money is the icing. If you are not happy and you're miserable, it doesn't matter how much money you have, the icing, okay? If you have a bad cake and you try to slather it and cover it up with a whole bunch of icing, the cake is still gonna taste like crap, because the cake, the life, is miserable. But this is where things get interesting, because if you have a great cake but no icing, the cake is still not as good as it can be, because the cake is going to be dry. Money is still a part of the life. You still need the icing on the cake. You can be physically fit and mentally fit and spiritually fit, the first three things in the quadruplet triangle. But if you don't have money to pay your bills and eat and do things that you love, you still can't live the fulfilled life. Money is fuel. It's a tool. It amplifies who you are. If your goal is to feed hungry people and you only have $100, you might not be able to feed that many people. But if you want to feed hungry people and you have $1 million, now you can feed a whole lot more people. And if you want to be happy and live your life to the fullest, you need to have money, but you also need to have the physical fitness and the mental fitness and the spiritual fitness. That way money can amplify your life. That way you can live your life to the fullest. This is really the core of financial education. Yeah, financial education is all about using your money the right way and investing your money and growing your money and earning more money. But at the core, if you do not understand how money plays a part in your life, that way you can live the best life possible, what's the point? Remember the building blocks: physical fitness, mental fitness, spiritual fitness, and then at the top of it is financial fitness. You need to have the bottom building blocks before the financial fitness can really amplify your life. Now, once you get to the financial fitness part of your life, that's where it's all about learning how to use your money and invest your money and grow your money. Thank you for watching. If you enjoyed this video, here's a video on things you need to know if you want to become wealthy that I think you love. And while you're at it, download our free guide on investing your money in the stock market. And as always, keep hustling. You have Robert Kiyosaki, who is essentially like finance everything, never pay for cash for anything, and then use your money to buy investments and have your investments pay for all of your stuff.